What's up, everybody? Welcome to another video. My name's Athena, and in this little lesson we're going to talk about risk management. Now, risk management is the reason why a lot of traders lose money. It's just the way it is, and it's the reason why a lot of traders lose money very, very quickly. Now, we're going to talk about what risk management is, trade setup, size, entry, stop loss, take profit, DCA, and a little conclusion. The first thing we have to understand is what is risk management, right? When you're a trader, you will have losing trades. That's just the way life goes. You're not going to be able to have a 100% success rate, and you have to be okay with that. Now, the whole goal here is to make sure that those trades that you don't do well in, you have to keep your losses minimal, right? That is the key to having a good amount of success while trading, is just to keep those losses very, very minimal, to keep your risk to reward ratio pretty well. Now we have to talk about a few things. Don't trade what you can't afford to lose. I'm sure you've heard of that 1,000 times, but we gotta reiterate it, right? If you're loaning out or borrowing money from your mom or your uncle or your brother or whatever, don't trade it, please, because most traders do lose money. So you don't want to lose money that you can't afford to lose. So only trade with money that you can afford to lose, that you're okay with losing. So if the money were to go away tomorrow, you'd be like, that sucks, but I'm okay with that. I'm not gonna go homeless. All right, so risk management in general, you have to make sure you have a plan and you have to stick to the plan. Now, these are probably the two hardest parts of trading. It's just having the plan and sticking to the plan. The other part is emotions, but we'll cover that in another video. So you have to be able to cut losses when a trade is invalidated, right? If you have a trade and you're like, this is good, but now TA is telling me maybe it's not good anymore, right? You have to be able to cut those losses. You have to use a stop loss. That way you can minimize your losses. You have to take profits. Please take profits. That way trades that doesn't reverse on you. And also don't have too many trades open. All right. So those are the main things that we'll discuss, but we'll review some other stuff. But risk management, extremely important. Extremely important. So make sure that you are really paying attention to the section and implementing it, because I've seen a lot of traders, even though they're excellent, right? They can, their TA is impeccable, their risk management is awful, and if you don't have risk management, you're going to lose money and you're going to lose it quick. All right, now let's talk about a trade setup. So we're going to go to TradingView, and we're going to go to this tab right here. You have a long and a short position. Now this is important when you're entering a trade. So we're going to do long position. Let's say we wanted to enter right here. Now the first question you're going to ask yourself before you enter a trade is, why am I entering, right? If you don't have a reasoning why you're entering that trade, do not enter it. But if you do have a plan, right? You're like, I'm entering because I can tell this is a good support. There's a fib here, yada, yada, whatever it is, right? There's reasoning why you're entering that trade at whatever price level. Good. Now we have to figure out your risk and your reward. So if you have this long position set up, as we can see right here, this gray line is your entry. So if you're putting, right, double click this, we're putting $1,000 into this trade. So your midline is right here. So this is where you entered your trade. The red box, this is if price were to go down here, you'll be negative, right? So the lowest portion of this is your stop loss. So as we can see, the lower you have it, the more you're risking, right? So this is 20% of the trade. So if you were to put $1,000 in there, right, you would pretty much risk 20% of that. So you don't want to risk all that much within that trade, unless you're swing trading, but that's a different thing. But we're just going to discuss the trade setup, right? So let's say you entered here, your stop loss, you can move that up and down. Of course, the tighter your stop loss is, the more probability you're going to get stopped out, right? So if you're doing leverage, it's going to be in a different video, but for this video in particular, we're just going to focus on spot, right? So your stop loss, you have to move it around, see what you're comfortable with. If you're entering it based on a support, then your stop loss should be below that support. But the tighter the stop loss is, the higher probability that you're going to get stopped out of that trade. So your stop loss is basically your invalidation, right? So if you're entering a trade and you're saying the support is here, I'm entering a long position, I have my stop loss here below support. If we were to drop down to that support, you have your stop loss here, right? You would have gotten stopped out. But if you're in a position where you're entering the trade, you have a stop loss and you're not respecting the stop loss that you put for yourself, you're going to allow yourself to be down a lot more than you would have. And then you're going to end up panic closing it. So make sure that if you have a plan, right, you are entering the trade, you're looking at your stop loss and you're saying, I want to have it here below the support. I'm only risking 2% out of the $1,000 that I put in. And my next target is going to be, say, here, right? Or maybe your first TP was here, second TP right here, right? You have to make sure that you stick by that plan that you set for yourself. So this is what we're talking about. Setting up a plan. I'm entering because X, Y, and Z. The trade setup. This is my entry. This is my stop loss. These are my take profit areas. This is what we're talking about when it comes to a plan, right? You have to be able to plan out every single trade. If you don't have a plan, you're not going to do well, right? So if you're looking for consistent results, for consistent improvement, you have to make sure that you are making a plan, that you are respecting your plan and not deviating from that plan. So if price were to go down there, right, to your stop, and for some reason you didn't set it up because you thought that it wasn't going to go, you have to be able to look at, you know, the chart and say, okay, well, we did break support. I can wait for the retest and then close it. But more importantly, you should have already had the stop. And if it stops you out, it is what it is. You will have losing trades. You have to be okay with that. I would rather take a stop loss than be down a whole lot, right? So we're going to talk about scenarios where stop losses are extremely, extremely important. And I'm going to discuss that for charts that I've spoken to, you know, a few of our members about. So this is an example of a chart, Wi-Fi, Wi-Fi, whatever you want to call it. So let me get rid of this real quick. We can definitely see a very, very good support that, you know, end up holding us up for numerous times, right? In the green box, right? We know that the support is here below, right? If we were to break, we'd look at the next support, which would be pretty far away, right? So you were looking to enter here. A lot of members, or a few, not a lot, because this coin's not really that popular, but wanted to enter Wi-Fi, right? And for me, this would be a very important support that shouldn't break, right? Shouldn't really break for me to, you know, still feel well about entering the trade. So let's see what happened after. So we had the breakdown, we had the retest, and we failed the retest, right? So we saw price go up here and get rejected. Now let's see what happened way after. So being able to cut that loss, right? Oops, let's do long position. Right, you had your support below, or your stop loss below that support, right? Because you're like, if it breaks support, I don't want to have this coin anymore. So you lost 7% within that trade. So if you put $1,000, you lost 7%. But if you would have kept it, you would have been down 77% on that trade. And even now, as we do have a little bounce, you're still down 44%. Now, this is the reason why we need stop losses in certain times where, you know, trend's not really looking all that well and there might be a little bit more downside. I would take a 7% loss over 40 or 70% loss any day. So this is the reason why you need to have stop losses within your trades to allow you to minimize those losses, 4% to 77%, right? Those are both big differences, right? So if you'd have put $1,000, you're down $770, right? And you're only up 200, or you only have like 200 something dollars of that. Hopefully I did the math right. But so $200 versus 7% risk, right? You lost $70 versus 700. Hopefully I did the math right. But that's the point of stop losses, is you have to minimize those losses, right? Now let's talk about size, or not size, but risk, right? So a big thing is whenever you are entering a trade, you have to make sure you don't risk that big amount of your portfolio, right? So the reason why a lot of people lose money is because they full port. I'm sorry, they put way too much into certain coins. What ends up happening is they lose it, and they lose it very quick. So this is an example of risk, right? So you have $10,000, and these are the numbers of losing trades. Of course, you may not have 15 repeating losing trades, but this is just an example of what risk can do for you, right? So we can see that if you risk 1% of that $10,000, it's very hard for you to get down to zero, right? Even if you have 15 losing trades back to back, you only are down $1,400 from your $10,000, right? Risking 1%. The higher risk you go, the more you lose. You can see 5%, right? At trade 15, you're already at 4K. 10%, money goes down very quick. 20%, money goes down even quicker. 50, you're pretty much done for after the fourth trade. And if you are full porting, more than likely you're going to lose it all, right? So my golden rule is 1%. 1% of my trades, leverage especially, for spot, maybe 2%, 3%. But any more than that, you're just going to put yourself in a pretty awful spot, right? Because if your trades were to go south, then you are losing a decent amount. So make sure that whatever your size is or how much percent you're risking is low. That way you can keep trading, right? You can keep trading. You're going to have losing trades. You got to keep those losses minimal. Lose less, right? Risk less of your overall portfolio. Now with the 1%, it might seem like it's a little bit, right? So it's only $100 that you're risking per trade. But I promise you those little increases of profit really make a difference versus having a higher percent that you're risking, because the higher probability is you're going to lose money pretty quickly, the higher percent you go. So less is more, really. All right, last but not least, something that will help you a lot when it comes to your trades. You have to write down your trades, right? You have to have a trading log where you write down every single trade. So as I mentioned before, you have to ask yourself the question of, why am I entering the trade? Right? If you have a reasoning why you're entering the trade, you have to write that down. You have to keep a log of your trades to make sure you're constantly improving. Especially as a beginner, the worst thing that you can do is just trade, right? The first thing you need to do is sit down and learn and test out, strategies that you might implement, stop loss strategies, risk management strategies, TA strategies, entry strategies, whatever strategies. You have to be able to sit down and actually test them out. So have a trading log, write down the date, whatever you did, if you are doing leverage or not, right? And really keep track of your stuff. That way you can keep improving, and you have to be able to keep yourself accountable. You are the one that trades. Even if you follow other trades, you are the one responsible for your own money. So if you want to improve, you have to be able to write down, reflect on your trades, what went well, what didn't go well. That way you can keep improving. So if you're testing out a strategy, maybe that strategy doesn't work, right? That is why you have a log, so you understand exactly what your mindset was when you entered the trade. You write down what went well, what didn't go well, what can you improve on, and you can keep making adjustments and changes within your trades, right? So a trading log is extremely, extremely important to keep track of what you're doing. Another thing is, a lot of people shit on paper trading, but when you are starting out, you should paper trade and not trade with real money. If you do want to trade with real money, trade with a smaller amount. That way you can get comfortable trading without actually losing, and you can get a good grip on what you're doing, because a lot of people just trade without knowing how to trade. But paper trading is going to allow you to test out what you're doing and if you're doing well, and then keep improving on it. But that is it for our video today. We talked about risk management. We talked about size. We talked about entry, stop loss, take profit. We talked about setting up a plan. We talked about setting up a log. But with that said, that is our video for today. I hope you guys enjoyed it. If you did, hit that thumbs up. Go ahead and join our Discord. It's free. But if you have any questions, jump in and ask us, anything that you like, or if you're stuck on something, and we'll be more than happy to help you. But with that said, thank you guys so much for watching, and we'll see you in the next one. Peace.